Hey there. Welcome to the SaaS Unbound podcast. I'm Tim Schumacher, your host today, joining for a special series where I chat with M&A experts about all things SaaS acquisitions. I'm the founder of SaaS Group, a serial acquirer buying wonderful SaaS businesses to take them to the next level. My guest today is Diamond, principal at Equity Software Group, a sell-side M&A advisory firm for B2B SaaS companies. Did I get that right? Is
You
that
did. You did.
your core specialty? But the company is a bit broader, right?
Yeah, so we work with exclusively software and tech companies, sell side M&A advisors, and we're kind of across the board. And when you look at the software and SaaS industry, so basically anything vertical we like. 80% of our deals are in vertical markets. And then we could get into some of the direct metrics, but I would say generally you got it right. Yes.
Cool, super. Yeah, but you just mentioned metrics. Let's dive right into these. Super interesting. Kind of, what are the metrics you're like? First of all, what are the metrics in your firm? Kind of, what is the ones or the size and everything your specialty is, but also in terms of metrics, what are you currently seeing? It's been an interesting year. What are you seeing in terms of valuations, new metrics becoming relevant, maybe old metrics that resurfaced? What's your broad take on the M&A SaaS market
Yeah.
these days?
Good question. So I'll start with SEG and then I'll go into the broader market. For us, any company between kind of $5 and $30 million in ARR, like I said, we love vertical SaaS. 80% of our deals are in verticals. High retention is a really important one. And I'll get into why that's so important. It does reflect kind of what the market is really interested in. So having net retention above 100%, gross retention above 90% is really important to us because it's very important to the market. And then when we look at, rule of 40, having companies that are growing with some profitability, that one we can play with a little bit, but we have noticed that the broader market is paying attention to profitability more than maybe they have historically. And that's just because the market is extremely risk averse right now. And then when we look at kind of product offerings, we like companies that are offering something that's mission critical to their industries
Mhm.
and also serving durable industries. So not going to be affected by major macroeconomic shifts, which would affect obviously their growth and retention as well. So that's SEG.
On a broad scale, what percentage of SaaS companies you rule out because they either don't have a proper NDR, not profitable, not mission critical, wrong geos? Like, what's how much is left?
Yeah, it's a good question. I would say if we're looking at 10, probably 1 in 10 are kind of
Really?
going through those filters.
So,
We
so
evaluate
does
a
that
lot.
mean that then 9 out of 10 is basically unsellable in the current market, or you just wouldn't touch it as a firm, or they just have to be discounted so heavily, or how's your take there?
Yeah, it's more so, I would say most of the time it's just not the right time. So we're
Mhm.
saying, hey, go work on X, Y, and Z, come back to us in a year or so, and we'll take another look. A lot of the companies we look at are phenomenal companies. It's just not the right stage for their life cycle to do an acquisition right now or for us. So, for example, if your net retention is at 90%, we're saying, hey, why don't you try to work on this retention for a couple years? And then
Mhm.
we would love to work with you
Okay, so you
because
give them homework.
mhm, exactly
Okay.
right.
Are companies successful in improving their NDR, for example, or is it really business model imminent, whether you're more SME, consumerish, SaaS or B2B? Have you seen a lot of companies where you give them that homework and they come back and they're like, hey, Diamond, I'm back. It's 2 years later. I've done my homework. Did it work?
We do. We see that often. We have relationships sometimes that last 5, 10 years where, they're working on the business, they're growing the business, and then they come back and we work with them and we're highly successful. So we do see that happen.
Cool. And all the other ones, do they then go to other brokers or they abandon their thoughts? Or what's happening
Yeah.
with all
So
the ones that are unsellable in the current market?
So the other ones that maybe they want to go right now and it's not a fit for us. So the metrics aren't right. They're serving an industry that maybe we're not particularly interested in. They sometimes will run a process with another bank and sometimes we see them
Mm,
being successful. But there is sometimes a valuation discount when it comes to not
mhm.
hitting those metrics that we like to see in businesses.
Okay. Would you say that in the end, that very careful top of the funnel picking is also one of the things that contributes to your very high 85% first pass success rate. Do you think that's, or are there other factors which are contributing to that? And but maybe one other question. Let's explain to the audience. You can do that better than I. What a first pass success rate is,
Yeah,
because it's
absolutely.
an M&A metric, not a standard SaaS metric.
Yes. So it's effectively going to market the first time and being
Hmm.
successful in the exit. So, sometimes you will take a company out two, three times, run two, three
Hmm.
processes, and then you're successful in the second or third process. For us, this is, 85% of the time when we're taking a company out, we're successful in the first time we're taking them out.
Yeah,
So,
which is important because I guess once you do it for the second or third time, rumors are out and people say like, oh, they didn't manage in the first place, so it generally depresses the price, which is why the first pass success rate is such an important metric in M&A
yeah,
to get it
I
right
think
the first time. Yeah.
Yeah, it's also important for clients because a lot of the companies we work with are bootstrapped businesses, and this
Mm.
takes a lot of attention away
True.
from the business overall. And there's also a cost associated with, lawyers' fees, third-party consultants, whatever it may be. So it takes a lot out of the business. So being successful the first time is really important.
Yeah, yeah, that's right. So is that the time it takes the most challenging step in the acquisition process for you,
I mean,
or for
yeah,
the founder?
I would say for the founders, if it's a bootstrap business, I would say the time and attention it takes away from the business is a big part of it. You know, a lot of times bootstrap companies also don't track a lot of the metrics that the market wants to see in an acquisition process, which takes time for both us and them to be working and getting all of that stuff together. And I would also say, and Tim, you probably know this, there's an emotional aspect to selling a
Yeah.
business. So it's a lot of management of the emotions on both sides of the table, so sellers and buyers, and making sure that we're providing information in a timely way. We're being responsive to both sides to make sure that emotions don't run too high, where that's getting in the way of the acquisition process overall.
Yeah, and that's, I mean, speaking from my experience as the acquirer, so the ultimate buyer potentially, that to me is the biggest value a good broker brings.
Mm-hmm.
One thing is sure sifting through the data and everything, but the emotional guidance as someone who's not on the other side, but who's on the side of the seller, that's something I really value. And that's also which really distinguishes a good from a bad broker more
Yeah.
than anything else, because collecting numbers is like almost anybody can do that, but really kind of that managing that process, smoothing those emotions. And yeah, as you say, it's a big step selling your
Yep.
baby,
Yes, it
especially
is.
for bootstrappers. Yeah.
Mm-hmm.
What would you recommend? Like, if a seller comes to you and thinks about that, or you've been in touch with him or her already for years, and they want to make that move, what would you recommend them to do first? Kind of, so can you share some tips or hacks on how to maximize value and find the right fit, kind of even before you go into the process?
Yeah, this might be a little bit self-serving, but for SEG, when we're evaluating a company, we look at companies based on a scorecard where we're saying, what qualitative metrics are you hitting?
Hmm.
What quantitative metrics are you hitting? So I would say the first step, if I was on the other side, is getting some sort of analysis done by somebody like SEG, where you're saying, you're the professional, you have your pulse on the industry. Where am I strong and where am I weak? And we are able to say, these are the areas, like we mentioned earlier, that you need to work on to be the most successful in your process. But in lieu of that, I would say make sure that you have all your numbers in order. Make sure you're tracking your MRR or your ARR,
Hmm.
you're tracking your retention numbers. Having good metrics being tracked is the only way that you'll be able to
Hmm.
manage your business to make sure that you're hitting those for an acquisition process. And I would also say, understand your vision. What's your vision for the
Hmm.
business? Is your vision just to have a strategic company come in, acquire it, and you sail off into the sunset? Because that's going to be a very different conversation than if you're saying, hey, I'm actually running my business for the next stage of growth. I want to find a partner, an investor to help me get to that next stage.
Hmm.
Those are two very different conversations into how you want to run your business
Very
and
true. Very true. It also rules out a lot of potential buyers or investors in the first place.
Mhm.
SaaS Group, for example, we only do 100% acquisitions. And yes, we love to do earnouts and love to partner with the founders, but it's a very different game than the classic private equity game where it's like, okay, sweat for 3 4 years and then let's flip the company together, because we don't flip companies, for example.
Mhm.
We want to run them indefinitely, and that's of course a very different game, and for some it's the right game, for others, other buyers are the better fit. Brings me kind of to the next question. But you said something very important, Diamond, is that you should have that discussion prior to going into the process. And I see that a lot of sellers actually, once the first offers are coming in or the first interested parties, then they start to think through those questions,
Mhm.
which is can be quite time consuming then when you think, hey, they should have thought about those things before. But like when they're at this point when they have actually interest, not necessarily a letter of intent, but actual interest from potential acquirers, what would be your recommendation then for sellers to look at those acquirers to select who is the best fit?
It's a great question. And we see that sometimes where people are coming to us and saying, hey, we have offers, but now what?
Yeah. Now what?
Valuation is obviously important. Terms are very important, which I think sometimes if you are a bootstrap business, you see a big number or a good number that's good for you, and you're saying, this is great, but all the terms of the agreement are
Mhm.
maybe not as seller favorable. So that's something that we always like to look at. But let's say the valuation terms, all else equal, I would say number one thing, going back to what I was saying earlier, what is your ultimate goal? Do you want to be part of a larger organization,
Mhm.
or are you just fueling growth for the next stage of your company? That's going to determine, hey, are you going with a strategic business? Or are you
Mhm.
going to a private equity? Or are you going somewhere in the middle? Which leads me to the second point. Is there a shared strategic vision for the business?
Mhm.
So, do you want to enter new markets and go a mile wide? Or do you want to dominate your current market and go a mile deep? Or do you want to do a mixture of both? And does the acquirer match your vision for the business?
Mhm.
And I would say the third thing that we hear a lot from our clients, because we work with a lot of bootstrap businesses, is there a good culture fit? We find that a lot of CEOs are saying, my customers and my employees are the most important thing to me. If my acquirer or my partner does not match the culture fit for my business, it's just not a good fit for me.
Okay. So I think number one is clear, kind of the first bucket, terms, valuation, all of that is clear. But on number two and number three, so the strategic fit, but also the cultural fit, how do you
Mhm.
find that out? And how do you help sellers find that out and also make sure that the buyer isn't just painting everything rosy, but at the end of the day, they don't care neither about the employees nor the customers, nor do they share the strategic fit, but they just want to get this deal done. How do you find out what they really want and need?
Yeah, it's a great question because while we are managing the process, we're the intermediary between the two sides. We are trying to interface the two sides as much as we can. I think, number one, making sure the two parties are talking to each other and having the our clients, the CEOs, the management team fully in the loop of everything that's going on and being very transparent and having visibility is first and foremost most important. But I would say a lot of people, and you probably hear this often, Tim, is this is a marriage. It's a two-way street.
Yeah,
We are selling businesses. We want to position companies in the best light possible. But, the buyer or investor also has to sell themselves, right? Our
right.
CEOs don't need to sell their businesses oftentimes. They're running their businesses because they're excited about the next stage of the company's growth. So making sure that the other side of the table also has the opportunity to sell themselves to our clients and
Yeah,
talk about the vision for the business, talk about past experiences with acquisitions and investments and how those
yeah,
have been
agree.
successful or not. So that's a good way that we're able to do that.
No, that's a great point. I agree. And if I recall the cases where we lost a deal, which we really wanted to have, I always went back to myself as like, hey, Tim, you didn't put enough effort in actually taking the time, sitting down with them, selling them on your own vision, but treated it too transactional. And the cases where we won successfully deals were often cases where we spent that time and established that relationship. And also there, it culturally clicked. Difficult questions I always find is like, okay, I think we all agree that those three buckets are important, but what are the trade-offs? That's so like just random example. If you have someone is paying 100, just index 100 million, billion, whatever, 100 with little cultural fit, and you have someone else paying 80 with a great culture and strategic fit, whom would you advise to go with?
That depends on our client. And I think
What do
there's
most
always,
clients pick? What would they pick? What do you think?
it depends on the gap. So
Okay.
if
Yeah.
the gap is 50 to 100, I think that decision is pretty obvious for anybody. But if the gap is 85 to 100, oftentimes we see our clients saying,
Yeah.
I'm sticking around. My customers and my employees are sticking around. I would rather go with the company that has a better fit. So we see that a lot. Always, you're going to see somebody that's going to take the bigger number. It depends on the client, but if it's close enough, I think culture fit really comes into it, and strategic fit comes into it
Okay.
heavily.
Is it fair to say, kind of rule of thumb, somewhere in the 10 to 20 range? Like you can win over with cultural and strategic fit. If it becomes too large, then money would always win.
I think 20 is pushing it. I think in that 10 range is
10 is
probably
okay.
a good measure.
Yeah. Okay. Good. Fair enough. Also, kind of staying a little bit on the data side a bit, is that, can you share any while we're talking prices and everything, can you share any acquisition data on bootstrap SaaS companies? Because a lot of our audience is actually bootstrappers, build companies to a couple million in revenue. It's like, what are you seeing in the market? What data do they command? Is anything different for them than for others? What are you
Yeah,
seeing there?
we don't have any, I can't share any specific metrics around
Sure.
the bootstrapped businesses. But I can say that when we're looking at companies that are bootstrapped, the processes are very similar. And I would say when we're looking overall, the valuations are very similar. When we're taking companies to market that are PE backed versus bootstrapped, we position them as we would either one, and we're trying to get the highest valuation for either one. So I would say the metrics are fairly similar when we're looking at the
Okay.
broader market.
So, but I guess what is easier is the stakeholder management, right? Because you
That's
usually
right.
have just the founding team.
Yes,
And
that's right. So the founding team, oftentimes with bootstrap companies, we're only working with the founders or the
yeah,
CEO. They don't open the tent to everybody else that's in the organization. And that also creates maybe a little more work in the preparation period where if you're PE backed or VC backed, you have numbers and metrics readily available and you're tracking things a little bit better.
right.
But for these bootstrap companies, their focus is how do I continue to grow? What am I doing the best for my business and my employees and my customers? And they're not thinking about all the minutia of a process. So that's really where SEG can provide a lot of value in either getting that material or putting it together for our customer clients.
Yeah, that makes sense. So I guess the advice for the bootstrap companies would then always pretend like you have an investor. But that's of course easier said than done, because that's the beauty of having at least a little investor. That's, by the way, the route we took with SaaS Group. We bootstrapped the company in the beginning. We had some exits before all of the founders of us, and of course always easier to bootstrap the second company than the first one. And
Yes.
so we did that, then did a little bit of debt, a little bit of friends and family money, but we opted to do a small equity round, but at a very, very late stage. Now, at the time when many other companies would have already kind of taken probably 100 million plus money. One of the main reasons why we took a little investor is because it forces us for the discipline of a lot of reporting, proper governance, proper board, and everything. And that's very often also the advice I give to bootstrappers. It's like, just take one person, give that person like 5%, someone who really delivers a lot of value, who has nothing to say in the actual business because it's a tiny minority, but do reporting, keep that person in the loop, and a lot of those things then develop organically without the overhead of managing dozens of different shareholders, which I've also seen many companies bring to the brink of collapse if the dynamics in the boardroom are the wrong ones.
Yes.
I guess the
Yeah.
downside of non-bootstrap companies.
And just learning best practices.
Yeah,
You don't know what you don't know. So having somebody in your quarter that's providing that guidance along the way is so
yeah.
tremendously valuable.
Yeah, speaking of dynamics in the boardroom, and we've seen some observed, so maybe that's my last question to you as a kind of a light way to end this. What's like the most, and of course, without naming any names, anonymized, but what's the most absurd story or like special story you've seen of an acquisition that either worked or didn't work with? It can be bootstrapped, it can be with a lot of different shareholders, stakeholders, but just some process that went like where you later be telling your grandchildren is like, oh my god, that was like the most crazy thing, and I wasn't this, and all of those things. You have any? I'm sure as a broker you hear a lot of things and you see a lot of things. What's like a crazy story to share anonymously, of course,
Yeah, it's
of
a great
how a
question.
deal that can go.
So, yeah, there was one company that I worked with very, very early on in my career that was working more on the health tech side. So, that's how much I'll give you. But when we were running the process, we knew this company was very high quality assets. It had all the hallmarks of an A plus business. And we were going to market. Our client was the one that was saying, hey, I want to be part of something bigger. Like this company I've been working with for decades that I know I'm doing something special, but I want to be something bigger. And the ultimate acquirer was one that you wouldn't have thought would acquire this business. It was so far left field. I think our client had maybe one or two customers in this buyer's industry where we said, there is some complimentary offering here. Let's include them in our list. It's probably low possibility. And this is a multi billion-dollar buyer. And we said, okay, well, let's include them and see what happens. What ended up happening was this buyer, very shortly before, maybe a month or two before, decided that they wanted to get into our client's industry. And it was just, everything aligned very
Mm.
perfectly to where, the buyer wanted to get into this industry. Our client wanted to be a part of this larger organization. All the management team within our client's organization wanted to be a part of something bigger. And so everything just lined up perfectly. And it really spoke to how SEG runs our processes to where we want to make sure that we're casting a wide enough net
Mhm.
and getting buyers to the table that may have some interest without spreading it too far to where we're just letting everybody know that this company is in market. And it just worked out perfectly. So that company is really running that division for this business, and all of that management team moved up in roles within this large organization. And it's a perfect case study for why hiring a banker and running a process and having a
Mm.
real clear strategic vision for your business makes a lot of sense and can be very successful for you.
Good. Yeah, great story, and also great advice for founders to not think too narrow. A lot of them
Mhm.
think of competition very narrow, and they think, oh, my competitors will buy this. But thinking about businesses that could go into that businesses, even if it's just a remote possibility, and who have certain assets that give them the ability to win, but they are not in this business yet, and casting the net a lot wider by including also very, very remote potential competitors. That's good advice. Super. No, that's a great story. Thanks for sharing that. And yeah, that I think brings us to the end. Anything else you want to share? Any advice for founders, or maybe last thing, if they want to get in touch, they're interested, how can they reach you?
Yeah, absolutely. So you can find any of SEG via the website or on LinkedIn. Feel free to reach out to me directly. But we do offer that strategic assessment that I mentioned earlier, Tim, where we could look at the business. This is all free of charge and just give you our thoughts on where we think you are in your life cycle and where we see some areas of improvement, areas of strength. So that's also an option on our website if you go and look for the strategic assessment. And I would say, I don't think we got into this a little bit earlier, but Tim, I'm not sure if you're seeing this as well, but we're seeing a really strong rebound in the markets with the Fed rate cuts, talks
Hmm.
about inflation cooling. We're seeing a lot of activity.
Yeah.
And we're really optimistic about, the back half of this year, 2025, after some, as you mentioned, some weird times a little bit earlier in this year and last year. So we're really excited. We are very optimistic for the next 18 months or so. So we're seeing a little bit of a rebound. It's
Yeah,
exciting.
we're seeing that too. Yeah.
Yeah,
And that definitely gives some hope also for sellers who want to sell their business.
absolutely. Absolutely. Well, I really appreciate the time, Tim. Thanks for having
Yeah.
me.
Yeah, thank you for being with us, Diamond, especially since you're already on holiday. Well deserved after 10 years at ESG. It was great. Thank you very
Yeah, I
much.
appreciate the time. Let me know if you need anything from me, but it was great chatting with you, Tim, and we'll be in touch.
Likewise. Thanks a
Bye bye.
lot.